Okay, so let's start now. Let's start now, so we're not going to waste our time. Okay, maybe others will be joining us soon, sooner or later, but let's start now. Okay, so yesterday we were talking about the pivot point and Fibonacci, Fibonacci retracement, because we have four types of Fibonacci. We have the Fibonacci retracement, Fibonacci expansion, Fibonacci extension, okay, Fibonacci time zone, Fibonacci hack. But yesterday we only talked about Fibonacci retracement. Maybe some other days I'm going to discuss about other Fibonacci. Okay. So today I will discuss about um, trailing stops, trailing stops and money management, money and position management. Okay. So we're going to discuss about trailing stops, trailing stops. What do we mean by trailing stops? Trailing stop is another great tool which can help in your forex trading. It is simple but can help you catch big move. There are a few types of trailing stop losses. Sometimes they are built in the trading platform. Okay. At times on MT4 we have this indicator called the trailing stop loss. Sometimes they are built in the MetaTrader 4 platform. Okay, it depends on the broker you are using. Some broker offer trailing stop loss indicator. Okay, so you can't find them in MT4 or MetaTrader, so you must download and install it. So that means there are times when you use MetaTrader 4 or MetaTrader 5, you can't find it there unless you download and install it. Like you download the file and copy it to your open data folder. Then from there you install it to your MT4. Okay, so that is why, because it's just a tool, it's not something that is inbuilt. It's not inbuilt. It's a tool. Trailing stop loss. So it's one of the greatest tool which can help trader to make money in the forex market. So it is simple but can help you catch big move. It is simple to attach it, or it is simple to make use of it, and it can help you catch big moves in the market. So trailing stop loss, you find the best version. You can go on Google, search for it. Then also we have how to use the trailing stop loss. Okay, when I talk about trailing stop loss, for instance, when you enter a trade, let's say you enter a trade at this point, okay, and your target is at this level and your stop loss is at this level. This is your entry, this is your take profit, and this is your stop loss. You decided to buy the trade. The price moved higher to this point. Your stop loss also will also move. That means your stop loss will not be found here anymore. Your stop loss will move. That means your stop loss. So that means your stop loss will not be found here. The stop loss will not be somewhere around here. When the price move to this point, your stop loss will not be here. That is why you can download the tools to make it to be automatically, like, to work for you automatically instead of manual, because most of the time there are two ways to use the trailing stop loss, either the manual or the automatic. Okay, so if you download the tool, you will set up, you make the setting, you do some settings there, how many points you want to make the price to be moving. Like for instance, if the price move from here to here 50 points, then your stop loss is somewhere here. So immediately the market reach 50 points, the market will still, the tools will automatically set your stop loss level again to 30 points. Okay, so it depends. Like if the price is moving higher, the stop loss also will moving also. The price is moving higher, the stop loss, and if the price is moving lower, the stop loss also will be moving down. That's what we mean by trailing stop loss. So idea behind trailing stop loss is very simple. If price is above trailing line, you should be long. If it is below the trailing line, you should be short. Simple as that. So the main advantages of trailing stop loss is that it allows you to stay in the trend and take big profits of that. Okay, so that's why I say there are some tools that offer trailing stop loss. Like if the line is above here, let's say the price is above the line, that means you should go long, you should be buying the trade. If the price is below the line, what does it mean? It means that you should go short by selling the trade. So as a beginner, you must also learn how to use your trailing stop loss. All depends on the amount of uh, amount of money you want to risk in every single trade you take. So when price goes up, it drag the trailing stop along with it. Okay, this is your entry. This is your stop loss. This is, you haven't set your target. So once the price goes up, your stop loss also will be drag along with it. Okay, let's say your the price rise to this point, your stop loss will now be somewhere here. You have already entered the initial level here. The price again still rise up, your stop loss also will be placed somewhere here. The price rise up again, your stop loss also will be placed somewhere. Now if the price now return back, it might hit your stop loss, and your stop loss, and once you hit your stop loss, you are stop out of the trade automatically. So that means you have already captured this move and also capture this move. But this, you didn't capture the move because the market came back, hit a stop loss. So trading stop loss is very important for beginners. You must trail your stop loss. But when the price stops going up, the stop loss price remain at the level it was dragged to. So it doesn't move. It remain at the level it was dragged to. Now, why use trading stop loss? A trading stop loss allow a trader to continue gain in value when the market price moves in a favorable direction, but automatically closes the trade if the market price suddenly moves in an unfavorable direction by a specific distance. Okay, so you just like when the price is moving your favorable direction, that the way you predicted, and the price is moving along with it, then your trading stop loss will allow you to make a big move so that you won't be burdening yourself. Okay, to make you make a big move. And also, if the price now eventually return back and doesn't move to your direction, you are stop out of the trade. Okay, so that's why it is very important to use the trailing stop loss as a beginner. Okay, so that you know that, for example, I've never took any trade that will use trailing stop loss. Maybe next week I'm going to share I'm going to share a setup that we're going to use trailing stop loss. So a trailing stop is a way to automatically protect yourself from the downside while locking in the upside. Okay, the price is moving higher, your trailing stop loss is also going along with the price. But when the price eventually stops or reverse down, you have already captured this move and it totally stopped you out. So that means you don't make any profits here. So you have already captured this move. But if you don't use trailing stop loss, your entry is here, your stop loss is here, and the price move higher, you are making profits, and immediately the price drop, no profits, and and again the price came down, hit your stop loss. So definitely you don't make any profit in this trade. So that is why one of the reasons why trading stop loss is very much important in trading. So a trailing stop order resemble a stop loss order. Okay, in that it automatically closes the trade if the market moves in an unfavorable direction by a specific distance. Okay, the key feature is that as long as the market price move in a favorable direction, the trigger price will automatically follow it by a specific distance. So traders often make use of trailing stop loss to lock in profits while minimizing their risks. That is another reason why we must use trading stop loss. Why you must use trading stop loss as a beginner. Okay, if you are kind of trader who doesn't want to be who doesn't getting close to your system all the time, or you are trying to or you are too busy, you can't get close to your laptop, to your phone, to every, or maybe you are too busy in the office and you took a trade. So when you use trading stop loss, it will make it make a help you make a profit. Okay, so most of the time, all this robot trading, all this auto robot trading that people use to trade, that people install to their MT4 and it trade for them. Most of the time they use trailing stop loss because the price we the market anytime the market is in a loss or is not going to direction where the robot is predicting, so the trade might close in a loss, might stop you out immediately and look for any other trade opportunities. All these trading robots, what they use, most people don't use, people that build this robot, they don't use higher time frame, they use lower time frame. That is why you cannot use trading robot to make for instance, you cannot use trading robot to make, let's say you turn $10 to $300. Trading robot cannot do that for you. What trading robot will do is that with this $10, trading robot can make a profit of 0.2 cents. Okay, maybe 0.2 cents first trade, 0.1 cent, 0.3 cent, 0.4 cent. Okay, so that is how the robot will be working. Robot cannot just make, let's say for example, from $10 make you $100. No, it doesn't, because people that use robots, that develop the robot, they use lower time frame. They don't use higher time frame. So that's one of the disadvantages of using trading robots. So if you trade by yourself, you know what you are doing. So also they make use of they use the method of trailing stop loss. That when the price is moving higher, it helps you capture big move when you are using trailing stop loss. So that is one of the most important things to use trailing stop loss. Stop you out when the price is moving against you. Already you have already captured the move, the previous move. Okay, so all depends on the point you want the market to be moving according to the price movement. Not that when the price is moving like this, the, the trailing stop loss also will be moving along with it. No. Once the price moves 20 points, the trailing stop loss also will move 20 points. If you set it to be 20 points, okay? But when the price moves 20 points and your trailing stop loss move 10 points or 50 points, let's say the price move 20 points and you set your trailing stop loss to be 20 or let's say 50 points. So the trend stop loss cannot move unless the price move about 50 points. Okay, so that is when you should use the trailing stop loss. Now, for example, setting a 50 pips, let's say you set a 50 pips trading stops on Euro USD after buying it at 1.2550. That means if the price rises to 1.2600, your stop would also rise from initial level of 1.2500. Okay, you buy at 1.2550. This is where you buy. Then your stop loss is 50. Okay, that means your stop loss is 1.2500. That is your stop loss, 50 pips. And if the price rises to 1.2, the price rises to 1 point, let's say 1.2600. The price rises to 1.2600. This is the level, 1.2600. That means your stop loss also will also rise from initial level. Your stop loss also will also rise from this initial level to this level. So from 1.2500 to 1.2550, your stop loss also will also rise from here to here. So that is how trading stop loss also works. So your stop will then stay at 1.2500 or 2550 unless the price move another 50 pips. If the price keep moving higher, that is 1.2650, then your stop loss also will move another 50 pips from 1.2550 to 1.2600. So this means that your trade will remain open for as long as the price doesn't go against you by 50 pips. So that is how trading stop loss works. Now, money management or money and position management. So let me discuss about money and position management. What is forex money management? Forex money management is a set of process process that a forex trader will use to manage the money in their forex trading account. Okay, like what method? What method are you going to use to manage a $50 account? You have a $50 account. What method are you going to use to manage this account? Maybe to grow this account to 500. What method are you going to use? If you have to grow this account to 500 for 1 week, what method are you going to use? How many? What will be your risk, and what will be your reward? Okay, what will be your risk? What will be your reward? Okay, so that is what exactly I want to discuss now. Okay, so when we talk about forex money management, it's a set of or a process that the forex trader will use to manage the money on their trading account. Now, we have the money management rules. We have the money management rules. For example, the first rules I want to discuss is defining risk per trade using positioning sizing. Define risk per trade using positioning sizing. The idea is that a trader should risk only small percentage of their account on any one trade. So trading mentors often preach the 2% rules, where traders should risk 2% of their trading account on every trade. You all know the rules that if you have $100 account, you must not determine to risk the whole $100 account, except you have, or except you want to risk, or you are capable of deposit another $100 account. Okay, but as you want to follow the rules of money management plan, you must define every risk you want to take trade in every trade you want to take. For example, with 100,000 CHF trading account, the trader will reach 2,000 CHF per trade. Okay, so you should know that okay, this is my stop loss. I should already reach 2,000 CHF. This is my balance. This is my balance. So that means as a trader, I must reach. This is the risk I should take. I should always reach in every trade I want to take. That means if I risk this, I should know the profit I want to make. So always define your risks per trade using positioning sizing. Some trader will vary the size of each trade depending on recent trading performance. For example, the anti-martingale money management method half the size of the trade each time there is a trading loss and double it every time there is a gain. A top trading strategy and a sound risk management plan should help a trader make money over time. But you can never be sure what will happen in the next trade or even the next 10 trades. So to mitigate the risks of the next trade being in a loss, the forex trader should keep one trade size relatively relatively small compared to the size of the trading account. So then taking this same principle and extending it, the trader should also protect themselves against several losing trades in a row by making the amount risk so small that even 10 losses trade in a row will be something that can quickly recover from. Okay, this is just a word for us for beginners. When you have losses of 10 losses in a row, what you have to do is you should know the amount of money amount you want to risk. That even these 10 losses also you can recover it. You can recover it. So it's not something that you delay. You can also recover these 10 losses and also make profit out of it. So then taking this same principle and extending it. So the trader should also protect themselves against several. They must also protect yourself against. But if the several losses occur, you must use small or you must risk small. That even 10 losses will be something that you can able to recover them all. Okay, so that is what you need to do when you want to define your trade path. That means you have to set down the rules that okay, this trade I want to reach out of $50, this trade I want to reach $20. So once the market is floating in losses up to $20, I must close the trade. Or you must make sure that okay, with this $20 which I want to risk in $50 account, that means if I take two trades, I must use 0.01 lot size. So if the loss is still floating in $20, then I have to close the trade. Okay, which means you can with this $20 you should know the amount of trade you're gonna take. You can decide to take one trade, you can decide to take two trades or five trades just for you to reach $20 out of $50 trading account. So the next one which I want to discuss is set a maximum account drawdown across all trades. What is a drawdown in Forex? A drawdown is the difference in account value from the highest the account has been over a certain period and account value after some losing trade. For example, if a trader has 10,000 CHF in their account and then loses 500 CHF, that is 5%. So that is the drawdown is 500 is 5% of $10,000 account. So the larger the drawdown, the harder is to recover the account balance with winning trades. I have a $50 account and I lose Out of this $50 account, $10. I lose $10 in this account. So that means my $10 is now 1%. I lose 1%. Next trade I took, I won. Let's say the first trade is I lost $10. That means I lost 1%. The next trade I took, second trade, I won $30. I won $30 out of $50. That means my drawdown will be 3%. My drawdown will be 3%. Okay, so out of two trade now, the first one is 1% and the second one is 3%. So I lost 1% and I gained 3%. So that means I'm still in profit, right? You are still in profit. Then you took the third trade. You have $40. The drawdown will be 4%. So you should also have a drawdown that will make you to know how you're going to recover the trade. So always have a drawdown to make you know how you're going to recover the trade. You can make your own drawdown so that at the end of the week you should know the amount of money you have already lost. You can practice that on demo account if you are a beginner. As a beginner, you can do that on demo account. Okay. Then the next one which I want to discuss is assign a risk reward ratio to every trade that you take. So you must also always assign a risk reward ratio to every trade that you take. There's a very popular goal to keep your risk reward ratio at 1:2 or 1 or even 1:3 proportion. That means that trader is willing to risk, for example, $2 per share and expect to earn $4 per share. That is 1:2, or $6. That is 1:3. Okay, assign your risk reward ratio. If the risk reward ratio is around 1:1, they do not enter a trade because it is not worth that risk. Okay, that means even though you risk $2 and you earn $2, so your at times you should not enter the trade because it doesn't worth that risk. But you must always be aiming at risking $2 to gain $4, like 1:2, 1:3, 1:4. But for beginners, you should always stick at 1:2 because if you leave the trade open to 1:3, the market might not move too far like that if you don't know where to stop the trade. Okay, so experienced traders who are looking for good opportunity know where to put stop. They do not enter a trade and then wonder maybe here will be a good place for stop loss. They basically know that even when they think about entering a trade, because they are looking for good risk reward ratio, keep that in mind. As an experienced trader, we know where to place our stop loss. Once you place your stop loss, you can just look for a good risk reward ratio, 1:2, 1:3. So it just doesn't matter, all depends on the amount of money you have in your account. Okay, all depends on the amount of money you have in your account. So always assign your risk reward ratio. Assign your risk reward ratio. Know the amount you want to risk for you to earn. Then the next one which I want to use is what I want to explain is use a stop loss. Use a stop loss and take profit order to plan, trade, exit. Always use stop loss and take profit order. Okay? Experienced traders or professional traders these days don't use stop loss. But for beginner you must use stop loss. Always use stop loss. This stop loss also help you to protect your account. Always use stop loss and take profit order to plan a trade exit. Always use don't be as a beginner, don't look don't always forget. You must not forget to use stop loss. Always use stop loss. Stop loss is very important. So the best practice is to set stop loss in the same time you are placing your trade or your order. You should know in advance when you want to set your stop loss. When you are placing your order, you set stop losses right away. Why? Because later you are probably going to hesitate to place stop loss. You might also place it in a wrong place because of emotion. So immediately you enter a trade, you must set your stop loss. Okay. Whenever you see me, I don't use stop loss. I don't like to use stop loss most of the time. In my trade, I don't like to use stop loss. But anytime I send a signal in the group, I always indicate where you should place your stop loss, right? But for me, I don't like use stop loss because I always like to watch the trade where it's going. If the trade, yeah, because I know the amount I want to risk. If the trade I took is still floating in loss and up to the amount I wanted to reach for that day, then I'll close the trade manually. So I don't like use stop loss. But as a beginner, you must always use stop loss. Always use stop loss. So don't be like me that don't use stop loss. Because I'm an experienced trader. So beginners always use stop loss. Uh very important thing. Always use stop loss. And you must use stop loss immediately you open the trade. Because later you probably going to hesitate to place stop loss. That means you might also place it in a wrong place because of emotion. So it's better to place stop loss immediately you open the trade. Then also the last thing which I want to discuss is that uh, only trade with funds that you can afford to lose. Last but not the least, successful trading is only possible when trader can make unemotional decision about what to do with a trading opportunity. If the trader needs the trade to win because the money is required for other purposes, the trader is liable to make bad decisions and increase the odds of losing money. Hope for the best and plan for the worst. So by trading with funds that you will not hurt your lifestyle if you lose them, always trade with a fund that you can afford to lose. A lot of us cannot afford to lose $30. So why must you deposit $30 to your trading account? If you can't afford to lose $50, you should not deposit $50 to your trading account. If you can't afford to lose if you can't afford to lose $10, you should not deposit $10 to your trading account. Because there's no 100% sure guarantee that any money you put into a Forex account, you make profit out of it. Okay, there's nothing like 100% sure out of it. So you cannot be 100% sure. You might deposit the money and lose it. So don't say because you know what you are doing, you're going to make profit on this trade and you deposit $50. That is the whole money you have. All the money you have with you is $50. Then you decided to deposit to your trading account. Believe me, you might end up losing the money, and that thing can cause someone to commit suicide. So it's better for you to trade with the fund that you can afford to lose. If you can afford to lose $50, yes, fine, trade with $50 account. If you can't, do not deposit, do not trade. That is what is killing most people today, and that is why emotion is getting higher, or it's emotion is controlling many traders today. You deposit $50, and this $50 you can't afford to lose this $50. You decided to deposit to your trading account. By the time you make profit out of it, even with emotion, you can end up losing the money, or you can end up because of fear to lose the money. You can at the end of the day you lose the money. So it is better for you to trade with the money you can afford to lose. Okay, so that is all the thing I have for you guys today about trading stop loss and money management plan. Trading stop loss and money management plan. So that is what we have today. Trading stop loss and money management plan. When you are a trader, you must always use trading stop loss. Always trade your stop loss. As a beginner, always trade your stop loss. About money management, the first thing you have to do is define your risk. That means always define your risk in every trade you want to take. Always define your risk. If you have a uh, $50 account, you must also define your risk. Okay, should I risk $3 account, or should I risk $3 on this $50 account, or should I risk $30? Always define your risk in every trade you want to take. Then also set the account drawdown, maximum account drawdown. Okay, if I win the 10 trade, if I win $10, that means I have 1% drawdown. If it is if I lose $20, means I'm losing, I'm still missing out 2%. Okay, so at the end of the day, maybe you now finally know what you are lose, know what you lose, know what you gain. Maybe you lose a lot, so it can help you to recover it once you know your drawdown. Also, assign your risk reward, your risks and your reward. You risk $1 to earn $2, or you earn to earn $3. You risk $2 to earn $4, or to earn $6, just like that. So always assign your risk reward. Then use stop loss. Any trade you take, always use stop loss. Any trade you take, always use stop loss. Always use stop loss. So know that you have a $10 account. For instance, you have a $10 account, and the stop loss you want to use is more than the $10 account. That is not trading. You should know that this $10 account, how much you want to reach in every trade. So always remember to use stop loss. Always remember to use stop loss. So don't be like professional. Don't be like experienced trader who doesn't use stop loss. They know what they are doing. But as a beginner, always remember to use stop loss. Then lastly, only trade with the fund you can afford to lose. Do not deposit big money and thinking that you're going to turn the money into millions. Deposit big money, and that money is only the money that you have left. And you think you're going to make profit out of it, but at the end of the day, you disgrace yourself. So always use the money, always deposit the fund you can afford to lose. Okay, always trade with the fund you can afford to lose. Okay, so that is that I have for us today about money management plan and training stop loss. I think today is the end of our class. So on Monday we're gonna start. Okay, I think today I supposed to give us some of our weekly forex analysis. Maybe tomorrow we're gonna do that tomorrow. But because I need to check, I need to prepare myself. I haven't prepared myself. I haven't go through the whole chart. So tomorrow we're gonna do that. Go through the whole chart. Go to this website Meta F, just to check all the currency index. I tried to use current trading view currency index. It seems that the trading view currency index is delayed. It's delayed for 10 minutes, so it's not. Uh, it doesn't correspond with this currency pair. Okay, so all the currency index here is delayed. Except you can always do that or use that during the weekend once the market is closed. But once the market is not closed and maybe the market is still running, it's delayed by 10 minutes. So that's why I always use this website to check the currency index. So it's real time quotes, okay? But the one of trading view is delayed by 10 minutes. So that is why. So tomorrow we're going to do our forex trading analysis, for forex weekly forex analysis. Okay. Okay, guys. Then about the video, the 2 days video. So I'm going to send it tonight. I'm going to share it tonight. I'm going to upload it to the group. So okay. So good night everyone and have a nice day. Bye bye.